Welcome to the REI Diamond Interview, your source for real estate investment jewels of wisdom with Dan Breslin.
Welcome to the REI Diamonds episode number 35 with Jay Hinrichs on new construction, private lending, and turnkey rental properties and how they all tie in together in one form or another. I'm Dan Breslin, and on the REI Diamonds podcast, my world-class guests bring their valuable experience as it relates to real estate investing. You're about to hear real-world experience from Jay on strategies and business methodologies that he is using right now in today's market to make money. So you may want to grab a pen and paper because I'm sure you'll want to take notes. I know I am ready. Welcome to the show, Jay.
Thank you very much. Pleasure to be there.
You know, the first place we'll start is how, we don't have to go all the way back to birth, but kind of your progression, first getting started in real estate, maybe a couple of the different businesses you went in as the markets changed, and up until what you're doing today and what your business looks like these days, Jay.
Okay, sure. It's quite extensive since I've been doing it about 41 years now. I literally got my real estate sales license at 18 in the San Francisco Bay Area. It took me a little trial and error to get going, but after about the fourth month, I closed my first deal, and, I kind of never looked back. So the base of my career, started in real estate sales, and then, you go through a natural progression. Next was a real estate broker at 20. By the late 20s, working with real estate developers in the San Francisco Bay Area. Got a good handle on how to do subdivisions and build those out. And then I morphed into hard money lending. I ran a couple hard money companies in the Bay Area, or one in the Bay Area. And then I had a quite substantial one up here in Oregon. And then after the crash, '08, as a hard money lender, and, anybody that was hard money lending in '08 like I was, and I had about a $40 million book out there, we ended up owning a lot of property. At that point, I realized, even though I have borrowers, I'm taking the ultimate risk. So in this new iteration post, GFC and '08 meltdown, I just decided to take more of an active role in the projects as opposed to just strictly lending to other folks, since I take, as a lender, I'm taking the majority of the risk anyway. And so that's kind of where I've morphed into. About 5 years ago, I created my own building company and my own private fund for doing other kinds of developments. And then I'm pretty deep into the turnkey space through acquisition and development, like flooring type funding for a lot of the turnkey companies out there in the United States. So that's pretty much the dime store tour.
I'll share with the listeners how I kind of discovered you, Jay. I was on Bigger Pockets, and I'm doing my best. I have a lot of things going on, but I like to go in there and, just check out some of the perspectives. And one of the double-edged sword that is Bigger Pockets is there's a lot of people who log on, create an account, and they're excited, and they posting a few questions, and they're sending a bunch of private messages, and then they kind of disappear and fall off the site. I don't know if Bigger Pockets is removing people from the site or if people are just losing interest, and the next thing you know, their profile's canceled. But I know that's been my experience, so it's a pleasure when I find somebody with the breadth of experience that you have had, Jay. And I noticed that you are a valuable contributing member of Bigger Pockets, and you have a lot of insight in response to people's posts and in your own posts yourself. Even in your profile, there's just a ton of experience, which was validated when we finally talked on the phone. And if anybody's not aware, Bigger Pockets is a real estate investment community, and I'll include the link to Bigger Pockets. You can check that out. It's a lot of cool resources, and you can meet a lot of different people from around the country who are doing things. So the first thing I did notice actually wasn't the hard money thing. I think it was the new construction piece. So, Jay, let's talk about, why did you start 5 years ago in new construction, and how has that developed into what you guys are up to today? Because you're kind of spread out a little bit on that, right?
Yes. We're doing projects in Portland, Oregon, Charleston, South Carolina, and we've just bought our first group of lots in San Antonio, Texas. It started out very simply. One thing that I was able to do through the GFC, I had very large credit lines with my local community banks here, and my core bank stuck through me thick and thin. And as you went through the GFC, the community banks ended up with a lot of REO, as we know. And in our market here, they ended up with a lot of land and lots. They looked inward to their best clients and basically, for lack of better words, made sweetheart deals, stuff that would go through an audit with the regulators. But we were able to have lots pretty much given to us and vertical financing at bank rates, 5% interest.
Interesting.
So I was able to pick off about 70 or 80 lots from my core bank. We'd have to put a little equity in, not much, and about what today's equity requirements are for a premier borrower, which is about 10% of cost. In some cases, we didn't have to do that much. And so I was able to get a foot in where, we bought at the bottom of the market. We had bank financing as opposed to competing against my builders here that had to borrow private or hard money. So my cost of capital was half. And then we also had a workforce that had been out of business. So I was able to hire fee builders, general contractors that would never have worked for me pre-08, but they weren't building any houses. They were out of business. That's all they know. And so they came back in and would build on a fee basis. And by getting your lots cheap from the bank, getting your construction costs as cheap as you possibly can, because everybody was sharpening their pencil, having a low cost of capital, we provided new product that was, 20-30% under what it sold for in the peak, and there was profit for us. So that kind of got us started, and then as that morphed, we got bigger and better, and we had a lot of retained earnings, and so we've just moved that forward and continued to expand. And I use that same model. I'm a license in Oregon. You can't flip houses without a license, even if you do one. You have to be either a licensed GC or you have to be a licensed developer. I'm a licensed developer. So that allows me to, be in the business, and then I hire a GC to, run the project for me. And I do that in each of these markets I'm in.
This is interesting. So I want to go back to what year was it exactly that you did the first new construction from the bank? This
would have been 2010, 2011. They got their defaults in 08. It took them a couple of years usually. By the time the builder developers went through the bankruptcy route, it took them a couple of years to secure their lots, and then we started buying them.
And what price point were the first handful of houses that came out of the ground?
Price points started at $240,000 and went up to $500,000.
So we have $240,000 to $500,000. What I'm curious is, and I know a lot of people stopped, or it's hard to cut back into new construction, or you're trying to figure out when the time is. And you have to excuse my ignorance. I'm not a builder, and I guess I'm working with limited knowledge of the market. But without any recent comps, was there any challenge with you re-entering the market and selling those first handful, or did you, and even from a personal psychological level, as you were building those first houses, was in your mind not such a huge risk because you had such a limited amount of money in there? Was there still a little bit of we got to hold our breath and see, if these things are actually going to sell? I mean, can you talk about that, those first 2 or 3 houses as you were getting started, Jay?
That's an excellent point. My bank, with my relationship, and this is why, everybody treats banks differently. Some people look at them as a commodity, and if Bank A will give you a quarter point less, you just up and take all your stuff over there. I've been with my same banker for 24 years, okay? And so he would have backstopped me. If I got in there and for some reason these houses wouldn't have sold, he would immediately have allowed me to term them out 20 years, doing 5 at 5% interest, and I would have turned them into rentals. So that was my backup if I couldn't sell them. he would have never foreclosed on me or called the loans.
And that was an explicit agreement that you had with him going in?
No, you can't have the agreement up front, but I just, that's kind of how I know he would have done that for me. I did build one, we did this as little as 18 months ago, where I built a group of homes, and I had one house that's on a busy street on a corner, and I just wasn't getting any action on it. And to sell it, I would have ruined the comps of my other houses. So I said, I really need you to term this out for me for 24 months. Let me get through all these houses. Then I'll just sell this one off for cost at the end. But if I sell it now, I'm going to ruin my comps for all my, and boom, they turned it right into a mini perm, so to speak. It's those kind of relationships with your commercial banks that are just invaluable. I just can't stress that enough. So I look at them as a partner, not as a bank, as long as it makes sense. And, we have to qualify, obviously. We are a for-profit enterprise, and we do make money. So we do qualify. We have perfect credit and all the other kind of stuff you need to be bankable. So as we went to sell this product, like the $240,000 houses that we started with in a little town called Hood River, Oregon, the 4 of them got built before the builder rolled over and went turtle. And they sold in the mid threes. I'm selling the exact same home for $240,000, and I'm making $40,000 a house. So there was no problem getting that comped. And by the time we were done, because I bought 30 lots there, and it took about 2 years to go through them. It's a little town of 6,000, so the absorption wasn't like you're going to build 20 houses and sell them all in 6 months. By the time we were done, those same houses had gotten back up to about 300,000. But we had locked in, the original builder was in the lots about 125 to 140,000 each, and we bought the lots for 35,000 each. So being able to move the price point down to move the product was simply a result of buying the land at far under replacement cost. I mean, you couldn't even put the streets and roads in. In our market, it cost you $40,000 to $45,000 just to develop a lot, and that's before you paid for permits. And then permits on top of that are another $15,000 to $40,000, depending on where you're at. So, like in the metro area here, by the time you get a building permit on a raw piece of ground, about $70,000 to $80,000 of that is improving your lot and getting your building permits.
So there were, 24 houses in that development altogether, and you built 20? Was that the numbers?
Well, no, it was a little bigger than that. It was, I think, 32 or 34 total. 4 were gone, and we did the rest. So about 28.
Got it. 4 done. So 28 houses. I'm making a couple connections here in my mind. And you mentioned that you didn't want to ruin your comps with one house. And I know that may not have been on this project, but now I'm starting to put 2 and 2 together, Jay, and I'm wondering, was it the market coming rip roaring back over the course of 2 years to bring you from 240 to 300, or is there?
Absolutely, it was the market. What happened in that little area of Hood River is there's a company that was started by some local guys there that was bought by Boeing, makes the airplanes. They make drones for the military. So the next thing you know, in this little, the gorge, the Columbia River Gorge where Hood River sits, which is a world famous destination windsurfing area, you have about 4,000 jobs comes into an area of about 50,000 people spread over 30 miles up and down the Columbia River. So the company came in and took every square foot of commercial in the little town, brought in engineers, and there was no housing. There was nothing being built. And so we did quite well. I actually built another 4 or 5 houses on spot lots, and everything I built there sold before it was done. We sold everything at framing stage. So it was a nice run. I'd like to have had more up there, but the next set of lots coming out of the ground were right back up to 120,000. So the margins were tight again.
Did you know that employment situation was, slated to change at some point in the future? Did you have some kind
It was happening. It was just happening right when we were buying it. The other thing is if I look at who bought my product there, it's not only from people that were working there, but we sold one house to some people who live in Australia. I mean, this is a world famous destination.
Interesting.
We sold a couple to Microsoft executives that love to windsurf and drive 3 hours from Seattle down to their summer home. We sold a couple houses to Portland business people that bought them as second homes, and they use them more than that. And then we sold the rest to families that live there that were working for this new drone company.
So let's talk about Texas, because I believe that's your latest, right? You had chosen these plots in Texas. Can you talk about how you chose those, if there were any market indicators or things like this situation with the job growth that influenced your decision and reason for getting into the Texas market there in San Antonio, Jay?
Okay, the reason we got into San Antonio is, one, again, I just don't go into a market unless I have a ironclad builder that's going to work for me on a fee basis. And that's where I happen to have one. Through a business relationship with another individual, he had financed a builder down there through before the GFC and through it. And again, the guy, rocky road for him, but very experienced builder. But by the time he got through the crash, he has no ability to borrow money or do anything. So we're able to get a guy that's built, 1,000 houses in the market to come to work for us, where if this was prior to the crash, he wouldn't even be talking to us. He'd have his own company like he had and borrowing from the banks, and he'd be his own builder. So there was this very unique set of circumstances coming out of '08 and continuing till today, where you have this highly skilled general contractor out there in the country that will, to get started again, they're happy to be part of a team. So that's the reason we picked that. We have a guy that can actually execute on the ground. I would not go just read newspaper articles about how great San Antonio is and then go down there and try to do it on my own if I didn't already know who these people were and trust them. So in that market, we're entering the $220,000 retail sales side, kind of like first time move up buyer. In Texas, as you know, it's unlike Oregon for sure. I can fly into town and spend 3 days and buy 5 lots, where I could come to Oregon and I could spend 5 months and be lucky to buy 1 lot. I mean, if you go on the RMLS in Oregon and you pull up lots for sale, we're 2 million people here. There might be only 50 lots for sale in the whole area on the open market. I mean, it's an acute shortage. Where I could go down to Texas, drive around with the real estate agent and say, I'll take that one, that one, that one, and that one. Which is what we did.
Why is that? I mean, what are the differences?
Because they just have, Texas is flat. Texas has had very lax zoning, and they developed, huge, large subdivisions that never got built out. So there's just a lot of standing inventory there.
Got it.
Where in Oregon here, between the urban growth boundary, which is an artificial restriction on building, and just the topography, we got the river on one side, we got high value farmland on another, and you got timberland on the sides. We're constrained, much like San Francisco Bay Area. You got the bay, and then you got the peninsula, and then you got the mountains. There's only so much land. You go to a place like Texas, and the land is virtually unlimited. Same with most of the Midwest. And that's why you can just keep continuing sprawling out into the farmlands. And land doesn't, unless it's, like in Chicago, like Wrigleyville, where it's very expensive, where people want to live in the inner city and they're willing to pay for that. But when you get out and out and out, the land values just continue to drop. So as we go over to Charleston, South Carolina, that's the exact same scenario as we have here on the West Coast. You have a peninsula, you have a very limited land supply, and then you throw in a very old historic type land where you have areas that are regentrifying, and a lot of the people that have owned that land over the course of the last 100 years or so, you have all sorts of title issues where, they never never got a divorce or they never probated their estate correctly.
Wow.
So you'll have land that's just sitting there, but the titles are all messed up.
Interesting.
So it's not uncommon when we go into escrow on a property there to take a year to get it cleaned up and finally get it done. Yep.
So what you just described is a constrained market, San Francisco, Oregon versus the commodity housing market where, you can run around and buy 4, 5, 6 lots. How many are you buying in San Antonio again, Jay?
Right now we started with, we've got 3 we closed on, and our goal is to do 3 a month. So we got 3 we closed on, and every month we'll be buying 3 more. The other thing down there is you can get through the permitting and processing and, a tenth of the time it takes us to get building permits here on the West Coast, and certainly in Charleston. Charleston, sometimes you have to go through architectural review. Nothing's like Chicago, but it's more stringent than we have here on the West Coast. And Texas is as easy as it gets.
What does that do to the profit margins from your perspective? Are you doing better, worse, or the same in Texas as you're doing in Charleston and Oregon?
Charleston, because we work so hard and the market is so red hot, percentage of profit, that's our highest. Texas will be production. They build super cheap there, but they also sell super cheap. So your profit margins are the least there. And Portland, you're right in that 10 to 14% net profit off of gross sales. So it's more production. We're not, you build a $350,000 house, and if you can net 50 grand on it, you've had a good day. I know I hear a lot of guys, especially on bigger pockets, talk about, $100,000 margins on 350 houses. And, the only people that can do that in this market here in Portland would be as if you land bank, you bought lots in 2010 that were $100,000 lots, and you snagged them for 25 grand from a bank, and you're making the profit just in the land move up. But if you're buying lots in the last year, they've already bounced right back up to pre-recession. So pretty much the builders look at 10, 12, 14%. And then they back into what they'll pay for land.
And what is that, the 10 to 14 probably expected in San Antonio too, Jay?
Yeah, I'd say that would be the same. If we can net after all cost and paying all our GC anywhere from 20 to 30,000 a house, that would be selling at 200 to 230 house. I think that's going to be a pretty good day. But we're gonna, we'll be shooting to close 3 a month, so it's a volume play.
Got it. So I know this question might be a little bit premature since you're kind of just getting your toe in the water there, but if you had your choice, which of these 2 markets, maybe if you were starting over versus constrained market with all the hurdles and the restricted amount of land versus the production, do you gravitate toward one or the other at this point, Jay, in your experience level?
I look at it completely different. I look at it this way. You can't go into Texas unless you have a builder who can build like the other builders for half of what it costs you to build in any other market in the country or less. If you don't have that guy, you're going to get killed. When you go into a market like Charleston that has exceedingly competitive land and you just can't go buy 20 lots. You can't where in the country a little bit, like where D.R. Horton is, 35 minutes out of downtown. But if you want to be in the inner city infill, those are the toughest. But you can also, the market, those properties command, the highest prices. And if you're in a deal a little bit more than you think you should have been, the market's going to rescue you. You may not make what you thought, but it's not uncommon for us there to make 20 to 25% compared to 12 to 13 out here in Oregon. But you're doing one infill we're not like the subdivision I'm building right now in Portland's 27 houses. They're all right there. I don't have to go hunting for lots. In Charleston, we're constantly hunting for lots, getting infill lots and having to go through escrow, and each lot is different and each plan is different. On the 27 houses I'm building right now in Portland, we have 4 plans. We know what they are. We know what they cost to build. And you just we started off with day one, we started 9 houses. We've pre-sold 3. So every time I pre-sell one, my bank gives me another construction loan. So now we have 12 going. And so we sold one on Sunday. And so they'll give me another start. And we should get out of that 27 house subdivision from when we started this August foundation. We should be out of it in about a year. By October of next year, I expect to be completely done. I can't go down to Charleston and build 27 infill houses in 1 year. I mean, it's just be very difficult. If I can do 8 or 9, I would be tickled pink. But out of those 8 or 9, we're going to make, $50,000 to $100,000 a house.
Got it. So my conclusion from that segment there is that for me as a fix and flip investor, I'm always searching for the deal. Then I go find the money to fund that deal. But it sounds like here, if you were going to do new construction, you would start with the builder as the first asset or limited piece of the puzzle of building new construction, then find the lots, then find the monies. Do I have that probably correct, Jay?
Well, you have to have the money at the same time.
Got it.
In Portland or Charleston, these are all cash sales, close as soon as you got title done. If you're not offering that, your other builder is going to beat you to it. You're wasting your time. The stuff you see on BP, well, let's tie it up and subject to my partner looking at it, and I'm going to put up $500 earnest money in a 3-month escrow while I try to go flip. That doesn't play. That doesn't work at all.
Well, cool. Why don't we switch gears a little bit here and we will talk about financing. And first, before we get into the hard money piece, which you have a very, very unique perspective on, and I'm excited to have our listeners hear that. But first, you had mentioned the bank relationship for 24 years, Jay, and maybe you could tell me and the listeners, how would I identify a decent sized bank, a type of banker who might be also interested in that type of relationship that would be beneficial for both of us? So are there some questions I could ask, or are there some things I could find out about the loan or the banker before I go ahead and try to invest the next 24 years, maybe with the wrong bank? Do you follow me, Jay?
Yeah, I can give you my slant on it for sure. I'm a huge believer in the community, and every community has community banks. Their mission statement is to finance the baker, the shoe repair guy, the small business that runs America. And so when you get in with a smaller bank, and like my banks that I've used is about a $350 million bank, which is a small bank, 4 branches. But when I go in, I know the president, I know the head credit officer. My guy I've been with for 24 years is now the head lender for the whole all 30 or 40 loan officers they have. So you're dealing with management to start with. 2, they're fiercely loyal. They want to help people in the community. And so once they get good clients that they think are good credit risk, good character risk, they go to bat for you. And believe me, these guys went to bat for me. I would not be here without my bank. I'll just flat tell you that. They got me through the great recession. I had credit facilities with 5 other banks that were sizable, $4 or $5 million each, and every one of them kicked. And they were big banks. They were multi-billion-dollar banks, publicly owned, and every one of them in the GFC. Well, even though you're not in default and blah blah blah, we don't like what real estate anymore. We're calling your loans.
Wow.
So my hard money company literally in 1 year went from $40 million worth of credit down to my core bank at $6 million. And they kept the facility. They still have it to this day. So what people do is you want to go out and you want to find that little community bank, and you want to start small, and then you just grow into it. The first loan I got with Dan in 1992 or 91 was a $100,000 line of credit. Just simple little $100,000 line of credit to buy distressed assets. And then it got to 2, and then, a year later, we're doing better. And then every year I would just keep coming back and saying, okay, look at our growth. And so at about 15, 16 years into the relationship, lo and behold, I end up on the largest, borrower at the bank. My high credit at one time in that bank in different entities, not only lending, but my holding portfolio. I had some office and storage stuff. I was at about 16 million with them. So that's how I grew that relationship from a simple $100,000 start to, but it took time. And I know part of what I see, and again, back to bigger pockets, is I see this, I want to get into real estate, but a lot of these people don't want to put the apprenticeship in. They want to go from 0 to 100 miles an hour in 6 months.
True. Yeah, you got that right on. Yeah.
They want to get rich quick. And, it's not you can. Some people will get lucky and hit it off. But this is how I've done it. So the local banks land on the 3 C's, which is simply character, collateral, and credit. And so, if you have poor credit, they're not going to lend to you. If your collateral is no good and you don't have any money, they're not going to lend to you. And then if you have poor character, i.e. bankruptcies, a history of walking away from debt or bad reputation, they're not going to lend to you. So if you can keep those 3 things going in the positive direction, you're very valuable to a community bank because they don't make any money if they don't have money out and earning interest.
Speaking of having money out and earning interest, that is a component of your business, Jay, the hard money loans. So let's get into that and kind of talk about your very unique style and structure these days to kind of protect yourself against what happened in 2008 to cause all those issues.
Right. So in 2008, prior to that, I had, as aforementioned, I had credit facilities with my banks, and so did most of the West Coast hard money lenders. And what that entailed was they would give us like a $5 million line of credit at bank rates. And it was a 1-year revolver. It would go for a year. We'd pay a point, $50,000 up front. And then we could loan their money out on a hard money loan. And we'd have to have 20% equity into each loan. So for every $5 million I had $1 million in cash equity in the business. That was actual capital, not borrowed, not somebody else's money. This is actual cash that was our cash. So every time I made a loan, what I would do is I would use my cash, my $1 million, I would go and make a loan, and then I would take, once it closed, within a day or two, I take it back over to the bank. I do a collateral assignment or I do an allonge, and then they tap into my credit line and give me 80% back. So that's how you kept those loans going. And it was a great business. We're borrowing at 5 or 6%, and we're loaning at hard money rates, and making the delta. And if you have a lot of money out, it's quite nice. After we went through 08, 09, where I realized that at the end of the day, I don't care if you have personal guarantees on borrowers or any of that kind of stuff. When you have a meltdown, it's all my risk anyway. Anybody who thinks they bring a lot of value just because they bring a deal, I don't agree with that. The hard money lender takes all the risk. And then I thought, okay, if I'm going to take the risk, I might as well just own this stuff and forget about having to foreclose or whatever. So my new iteration with, and I have a very deep Rolodex of guys that I funded for 20-some years. So coming out of 2010, as I had capital built up and I wanted to stay in the game, I just went back to my existing clients and said, okay, I'm back in the game. I'm going to fund your deals, but I'm going to own them. And we're all going to get paid the same day. None of this ARV lending, none of this, taking money up front. Everything is going to be at cost. And depending on who you are, you'll either have skin in the game or you won't. Guys that I've known for 20 years, I'm basically their business partner. I'm their capital partner. I provide the capital. They do the work. When we sell the asset, we both get paid. Nobody gets paid in advance. And so I started modestly with 4 transactions in Orlando. And today, 3 years later, I've done close to 400. And I have anywhere from I'll usually have 100 to 120 files going at any one time. And I've only had one bummer. I've had to bring on a few people I didn't really know. And I had one bummer down in Atlanta and a guy I didn't know. But I pretty much just stick to my Rolodex so to that extent, I don't have a website. I don't advertise. I don't really need the business that way. I'm like a bank. My banker is to me. I go back to the guys I know that have the character and the collateral and the credit and the ability to do it. And I'm like, okay, guys, instead of you out there trying to borrow hard money and the hard money lender or the private money lender does a deal and then he's out of money and, I'm waiting for a payoff. I'll fund your whole deal, but this is how we're going to do it. And so that's what we do.
So you're taking
relationship based.
So you're taking title to those, right? Is that?
Yeah,
I understand.
Mm-hmm. I'm a mortgage banker, but I just don't want to do all the lending and the NMLS licensing stuff. So I just take title to all the assets, and the guys in the field, instead of them being my borrowers, they're a joint venture partner, and they do the work, and we all get paid off the HUD. Real simple, like a contractor gets paid.
Who pays the contractors? Is that your office cutting checks periodically?
No. Again, these are guys that I trust. So okay. if it's I'll do some of the stuff in draws, but primarily the turnkey guys that I fund, their rehabs are running anywhere from 8 to 20,000, and if it's one of my guys that I've done, I've got turnkey guys I've done 400 deals with over the last 15 years. I just give them the whole money. I don't micromanage them in one bit. If they say the rehab's $15,000, I send them $15,000. And so and because of all of this is on accrual basis, there's no monthly payments to be made. It's very easy for me to manage. One HUD, I buy it. One HUD, I sell it. And it's all on the HUD. How I didn't think of this 25 years ago, but it's the best thing I've ever done. But it won't really work if you don't know the people, because they don't. A lot of them, well, I'm not going to bring you a deal. What if you steal it from me? I'm like, well, why would I do that? I'm in Oregon and you're in Orlando. If I stole one deal from you and didn't pay you, how many more deals would I get from you? Let's use logic there. So I've brought on a couple new people, but again, 90% of what I do is with people I've known for years and years.
Do you personally underwrite each one, or do you have a staff appraisal system in place to kind of handle that?
We don't appraise. We don't do. I run this by myself, and I have my daughter and son-in-law. My daughter does the books. My son-in-law, keeps up all our spreadsheets and makes sure insurance and all the little minutia stuff. Because there's no payments, there's not a big, huge accounting job. Like when I had my hard money company, I'd have 400 loans on the books with 400 monthly payments. I had to have 2 full-time people just in my accounting department.
That's nuts.
Here, I don't need it. It's a fun, money goes out, money comes in. In a transaction, there's only 2 movements in the checking account, a funding and a payoff. So it's pretty easy to manage. Yeah. And I don't need, and because the people I'm dealing with are experienced in their market, they've been there forever, I don't question the value. They're not going to buy it if it's not a great deal. I mean, these are the guys that buy the deal. These are the guys that many people aspire to be, wanting to buy the wholesale deals. So we're in them as cheap as you can possibly be in them. So no, I don't appraise anything, or I don't even look at them, frankly. I don't need to.
We do a similar, in my fix and flip business, we do a similar structure. So we're always looking for a balloon payment. We're always looking for, I don't want the guy lending me money. I'm not going to usually take a guy on who's, borrowing $100,000 line of credit against his house at bank rates so that he can lend $100,000 on my deal. And then I need to make a monthly payment so he can make the monthly payments on his house. That's not the ideal borrower for me. My ideal borrower, or lender rather, Jay, my ideal lender is, someone like you're describing, who's not necessarily reliant on that monthly payment every month for, the reasons that you just mentioned. It's an accounting headache to sit down and have to cut the checks, and now he's got to receive the checks, and, we're waiting for the check each day of the month, to come.
Well, when you talk that through, the other thing that happens with folks is, everybody's looking for the cheapest money they can get. But if you look at most folks, they get a little bit, it depends on what they want to do and how much they want to make. If you really want to scale either a turnkey business or a, fix and flip, where you really do some volume in a year, it's difficult to do that by borrowing hard money. Simply, even in our market here in Portland, which is the West Coast, which is pretty competitive. Portland's really competitive for hard money. The good flippers enjoy 10 or 20% at cash equity, 10% of cost, 20% of cost, but they still have to make monthly payments. And a lot of times they still have to pay the points up front. And your average deals here are $300,000 to $500,000. So, to do one or two deals, you still need $60,000, $70,000. If you want to have two of them going together, you need, $150,000 in cash tied up, and now all of a sudden you're making $5,000 a month payments, right, on your two deals. One of the bigger flippers here in town got a little bit twisted up, and I got a sheet from one of the hard money lenders. His payments were $110,000 a month.
Wow.
Because he had so many deals going and he has to pay monthly. So what I allow these guys to do is to scale their business up because they don't have standing overhead. They don't have any monthly payments to make. They don't have, the majority of them, they have no capital requirement to get the deal. They just have to do the deal, get it done quick. And for that, we take a partnership interest as opposed to, just an interest rate interest. So it works out great. And what works for me too, I'm blessed with, my money partners or investors, don't need monthly payments either. We're all on accrual basis. Everybody gets paid. The folks that I manage their funds for, myself, the flipper, everybody, we all get paid on that day. The HUD settles and the big check is written. That's when we pay everybody. So for someone who, really wants to do some volume, you're going to give up some profit, but you're actually going to be doing some deals. Or you just settle back into, okay, I got $100,000. That means I could do one or two deals, in a 6-month period or one or two in a year, and this is what I'm going to make. Until you go out and get, capital partners. And even if you get gap funders or capital partners to match up to your hard money, you're still going to be paying them part of your profits anyway. Right?
Yeah, anyway you cut the deck.
Yeah. Everybody looks for the elusive, wealthy neurosurgeon who's willing to put their money out for 8%. It's like, okay, they exist, but usually only to their kids.
Yeah, like looking for unicorns, right?
Yeah, there you go.
Jay, you mentioned the turnkey rentals. I mean, why would that work for, some of the people that on the West Coast? What's causing this turnkey rental business boom? I mean, everywhere I turn now, someone's starting a turnkey rental business and they're building out turnkey rentals. I
have a pretty deep history at it. There's not a lot of us that have been doing it. I would say continuously, I'm one of half a dozen people that kind of been at it since it started. It started around 2000. I started my first deals in 2001 in Detroit, of all places. And it's a California phenomenon, basically. What happened is in California, values already got totally out of whack by the mid to late 80s. In other words, like in Palo Alto where I lived, a small ranch, 1,000 square foot, 3-bedroom, 1-bed ranch house was already selling for $500,000 in the late 80s, right? But would only rent for maybe $1,200 or $1,400.
Gosh.
So when people would look at, so it just didn't make any sense. So nobody bought single family residential basically in the Bay Area for rentals. If you wanted to be in the rental business, you bought apartment buildings. Simple as that. Duplexes, fourplexes, and everything was done more on a commercial basis. So what happened was, America being America, some smart marketing type people thought, okay, well, if properties are that expensive in the Bay Area and Los Angeles, there's going to be people that want to get into the rental business. Why don't we bring the product to them? And so that started your first basic marketing and turnkey companies. back in around 2000. There might have been some prior to that. I'm not aware of them. And so you'd have a marketing company on the West Coast, usually started by a radio show. One of the Saturday radio show guys would line up with usually a West Coast-based marketer who would kind of coordinate the sales, and then they would get in league with the person on the ground in the market that would source the property, rehab the property, and have the property management, and they would tie it all together and call it turnkey. And then back in those days, if you remember how lending went, you could buy four properties at once. The lenders would do a 75% LTV cash out with no seasoning, which I'm not sure that was all that smart. So what would happen is because in the Midwest, as you know, you have appraisal value and you have real value, and the two are never the same. You can have an appraisal value, but you play hell trying to sell the property for that amount of money. And especially in the lower end, predominantly rental areas. So the big banks are forced into appraising and taking those kind of appraisals. So the pitch was in LA is, okay, you can buy 4 houses in Detroit. It's going to be no money down, or maybe it's $1,000 a house just to show you have some deposit. We're going to get you this hard money loan, which is going to put you into title. It's going to give the fix and flipper in the marketplace the money to fix your house up. Then we're going to do a reappraisal, do a 442 reappraisal, and then I'm going to get you a cash out refi. And out of each of these homes, you're going to take $7,000, $8,000, $9,000 of refi proceeds. You're going to do 4 at once, so you're going to get, $28,000 to $35,000 check back, and these properties are going to cash flow $100 a month. That was the scenario.
Oh God!
I did 2,000 of those.
Oh man!
Yeah, so we did those. So we were the 65% LTV lender that put everybody into title. And then, so out of that 65%, we got paid. The LA-based marketer got paid. The LA-based radio show person got paid. And, everything got paid out of that 65% LTV. So we get an appraisal. We would loan up to 65%. The person buying it would then get a 75% rate and term refi. Now that is alive and well again today. Although most of the turnkey companies have taken away that leg of it where we would loan to the LA-based person, and what they're doing now is they're buying their own inventory and just selling to them. But they're selling, these people are getting 75% LTV loans again, 70 to 75% LTV loans as lending has come back. So the reason it's so popular as well is you sit out on the West Coast, nothing makes sense in the single family. Multifamilies are very expensive. So this allows people to get started into real estate. If you got $20,000, $25,000 in the bank, 720 credit score, blah, 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 you can buy a rental house in the Midwest. And so, a place like BP or all these other marketing companies, they get people, the way to get wealthy is cash flow real estate. The way to get wealthy is long-term. Forget about appreciation. It's all about long-term. So this gets people started. It's get yourself started in real estate. And so thousands of these are sold every month all over the country.
Got it. Now, they're not no money down deals anymore, right, Jay? And I imagine you're making a little more than $100.
You could do. The problem is you don't, a hard money lender like me, I'm not going to do that anymore. You might have some guys still doing that. I know one company that is still kind of selling that model, but most of the companies that are doing it now will be, you can be no money down, but you got to pay cash for the asset, and then you're going to get a rate and term refi and pull all your cash back within a year. And now you have no money down. But most of the people, again, you're dealing with that person that's got a good job, good W-2, provable income, good credit, and it's got $50,000, and they're willing to put $25,000 down on a Midwest house and have some reserves, and then try to build their portfolio from there. And again, you still have I know other West Coast investors that are quite wealthy that they'll buy 10 of them and pay cash for them. They're looking for yield. They're looking for that 8 to 10 to 12% yield. And depending on where you buy and what you buy and if you have good luck or not, you can hit that.
Well, cool, Jay. We are approaching the top of the hour, so I have a couple questions here as we wind down. And the first is, do you have any book recommendations, real estate, business, personal development, or otherwise that you could recommend to our listeners?
For me, the one I read and that really resonated with me is Rocket Fuel by Gino Wickman. And Floyd Wickman is famous as dad. And my wife actually worked for Floyd Wickman back in the 80s doing motivational real estate seminars. And it's a great book for the entrepreneur to read through and decide, what kind of person am I? And if I'm not that kind of person, I need to hire this person to help me get my business moving. That's the one I like the best right now.
And the final question I have for you is, do you have any final jewels of wisdom to share with our listeners, Jay?
Well, I think, we're in a really good time. I'm not a bubble burst type of guy. I don't see a big meltdown happening anytime soon. I know a lot of people are talking about, I'm just going to wait for the next crash. They may be waiting a long time. Of course, I could be completely wrong. But the reason for that is you had literally 1 million transactions to foreigners that were all cash, so those houses aren't going to be lost. Lenders are much smarter than they used to be. Buyers that are buying property are actually qualified and actually have reserves. You don't have all this, 100% leverage into real estate, which basically caused the meltdown. And you take the whole subprime thing out, making loans to people that really only social programs deem they should have loans when they really shouldn't have any loans. You've taken those people out. So you're not going to have the same setup for a massive meltdown. You'll have cooling off, I believe, and price leveling out. But, rats jumping off a ship like we saw in 2008 to 2010, I don't see that.
Nice take. Well, Jay, hey, thank you for coming on the show. I got 4 or 5 pages of notes here.
My pleasure. And next time I'm in Chicago, I'll let you buy me a piece of pizza.
I was thinking of steak, actually.
Okay, I can do that too.
Yeah, we can do that. Cool.
Right.
Thanks, Jay. And thank you all for listening to this episode of the REI Diamonds podcast. Are you enjoying what you're hearing here? Maybe you know somebody else who'd also enjoy this episode, and you could forward the email or the link and check it out. You can also sign up to receive email updates of new weekly interviews at www.reidiamonds.com. And I'll also send you my special report titled 7 Sources of Off-Market Deals. The website, again, is www.reidiamonds.com. And you can also find us in the iTunes app. Just search REI Diamonds and click subscribe. Until next time, this is Dan Breslin signing off.
Thanks for listening to the REI Diamond Interview. To receive the REI Diamonds newsletter and interview monthly, sign up now at www.reidiamonds.com.